Most people who try trading lose money, not because trading is impossible, but because no one ever taught them how trading actually works. Beginners usually open a chart, see green candles moving fast, feel excitement, press the buy button, and then watch the market move against them. Confusion turns into fear, fear turns into losses, and losses make them quit while believing trading is a scam. The truth is that trading is not gambling, trading is not luck, and trading is not about predicting the future. Trading is a skill, and like any skill, it can be learned step by step if it is taught the right way. In this video, you are going to learn how trading truly works, how professional traders think, how to use a simple beginner-friendly strategy, how to avoid the most common mistakes that cause people to lose, and how to build confidence slowly and safely over time. Trading is not about guessing where price will go next. Trading is about reacting to what the market is already showing you. The market works like the weather because you cannot control it, you cannot fight it, and you should never try to force it to do what you want. Professional traders never say the market must go up or must go down. Instead, they say if price moves up, I will take this action, and if price moves down, I will take another action. This mindset is one of the biggest differences between traders who survive and traders who fail. Every chart is simply a visual battle between buyers and sellers. Green candles show that buyers are stronger, and red candles show that sellers are stronger. Institutions like banks, hedge funds, and large investors move the market, while retail traders follow their footprints rather than trying to control price. Your job as a trader is to identify where large money is likely active, enter when probability is on your side, manage risk carefully, and exit with discipline rather than emotion. There are three main types of traders, and beginners must choose one style and stick to it. Scalpers take very fast trades that last minutes and require constant attention and emotional control, which makes them difficult for beginners. Day traders open and close trades within the same day, usually taking 1 to 3 well-planned trades with clear structure and controlled risk, which makes this style ideal for beginners. Swing and position traders hold trades for days or weeks, trade less often, and rely on patience and planning rather than constant screen time. For beginners, day trading or swing trading is the best choice because it balances opportunity and emotional stability. At the beginning, you do not need complicated indicators or advanced systems. The best beginner strategy is based on price, trend, and support and resistance. First, you identify the trend by observing whether price is making higher highs and higher lows for an uptrend, or lower highs and lower lows for a downtrend. You only trade in the direction of the trend, because trading against it lowers your probability of success. Next, you mark support and resistance levels, which are areas where price has reacted strongly in the past. Support is where price tends to bounce upward, and resistance is where price tends to reject downward. Finally, you wait patiently and enter trades only when price reaches these areas in the direction of the trend, rather than chasing candles or acting out of fear. Risk management is the most important skill in trading, and it is what keeps traders in the game long enough to succeed. You should never risk more than 1 to 2% of your account on a single trade, because losses are a normal and unavoidable part of trading. Professional traders expect losses and plan for them, while beginners try to avoid losses and end up losing more. Winning in trading is not about never losing. It is about controlling losses so that winners can outweigh them over time. Your mindset will determine your results more than any strategy. You must accept that losses are normal, that you do not need to win every trade, and that consistency is far more important than excitement. When trading is done correctly, it often feels boring, because you are following rules instead of emotions. If you feel rushed, fearful, or desperate to make money quickly, then you are trading emotionally, and the market always punishes emotional behavior. Before risking real money, you should practice on a demo account and treat it seriously, as if it were real. Every trade should be written in a journal, including the reason for entry, the risk taken, and the outcome. At the end of each week, you should review your trades and ask whether you followed your rules, whether the trade was planned, and what you learned from the experience, instead of focusing only on whether the trade was a win or a loss. Many beginners fail because they overtrade, constantly change strategies, watch too many conflicting opinions, trade without a plan, or increase risk after a loss to try to recover quickly. Simplicity and discipline beat complexity and emotion every single time. Trading should be treated like a business, not a casino, and progress should be measured in consistency rather than speed. It is important to understand that trading is not a guaranteed salary, especially at the beginning. The first year should be focused on learning, protecting capital, and building discipline rather than making large profits. Traders who survive their first year with their account intact are already ahead of the majority of people who try trading and quit. Trading is not about money first. Money is the result of good habits, discipline, and patience. If you treat trading like gambling, it will take your money. But if you treat trading like a business and respect the process, it can completely change your life. You do not need to be rich, lucky, or extremely intelligent to succeed in trading. You only need a clear process, emotional control, and the patience to let time work in your favor.